Okay, so sale of goods. Let's look at that transaction, sale of goods. So as you appreciate, this is a transaction where the business is selling goods or stock. So for example, if we are a bookshop business, then our goods will be the books or our stock will be the books that we sell, right? So you all remember that when a business sells goods, the effects are decrease in asset, which is always the case because you are selling the goods, so your goods will decrease. So the asset stock decreases. But the other effect depends on whether we took money for selling the goods or we didn't take money, as in the customer didn't pay. And please note, we sell goods to our customers, right? We sell goods to our customers. Okay, so if we sold the goods and we took money, as in if we took cash or check, then we are saying that the corresponding effect will be increase in asset, cash, or bank. The bank is in place of the check. So where you took check, the asset you consider is bank. So dear professors, don't repeat checks when you are doing the analysis. It should be bank, right? Okay. So where you took money as in cash or check, then the effect will be increase in asset, cash, or bank, and then decrease in asset stock. If the customer didn't pay or the business did not take the money from the customer or the sales was done on credit, then again there will be decrease in asset stock and increase in asset data. Professor, do I have to go over this again? Okay. So my professors are very okay. So now let's pick an example and see how we can do the analysis. Okay, I see something in the chat. Is it for me? The person said, okay, yes, we are okay. So let's take some examples on this sale of goods and see the effects and possibly also look at how we record it in the account. Okay. So let me make the screen bigger. Okay. Let's look at this transaction, which says sold goods to Kwame, 1,000 Ghana cedis cash on 7th January 2022. So my dear professors, what is the effect of this transaction on the accounting equation? Let's look at the effects. Okay, I have Portia ready. Oh, I want to see more hands. I want to call Portia. I'm sorry, let me call some other professors who are hiding. They want to hide in the Flapstar house, but I'll catch them. I'm catching them right now. Prof. Okay, I'll call Prof. Abubakar first because we are in the month of Ramadan. Is that the case? And we are fasting. And those of us who are fasting are very sharp when it comes to answering questions. So, Prof. Abubakar, let's hear you on this one. What is the effect of this transaction? Yeah.
Sir, please, I don't really get it.
Okay, so I'm asking that if a business sells goods, okay, so here the business sold goods to Kwame and the business took cash. Okay. So the business sold goods to Kwame and got money from Kwame. So as an accountant, would this transaction, how would it affect the assets, liabilities, and capital? what does it increase or what does it decrease?
So please, there will be an increase in assets.
Okay, which specific asset?
Sir, please, cash.
Thank you. Thank you. Awesome. So there will be increase in asset cash because the business is getting cash from farming. Good. Can you also tell us the other corresponding effect? So if the cash increases, what again happens?
And there will also be an increase in capital.
So that's where capital will not come in here because this transaction has nothing to do with the owner, right? The owner is not doing anything here. What is happening here is the business selling goods to a customer, right? So you got the first one correct, but the second one you may have to consult with Prophet Muhammad and come back. But I appreciate the first response. That was great analysis. So let me pick from another professor. Eugenia, Prof. Eugenia. The business sold goods, and we know the goods is the stock, right? So the business sold some of the stock to a customer and got cash. And Prof. Abubakar has told us that the asset cash will increase, and that's accurate. We need the other effect. Prof. Eugenia, can you assist me on this
one? Decrease in assets.
Okay, decrease in asset. What asset?
Stock.
Thank you. So there will be a decrease in asset stock. So Prof. Abubakar, the business the business is selling its stock, right? Selling the goods. So there will be a decrease in the goods, but the business also had cash. So there will be a corresponding increase in cash. So example, if let's say, do you do any business or does mommy or daddy do any selling, buying and selling?
Sir, I don't think so.
Okay. I wanted to set an example using that. But let's assume that maybe mommy is selling Quran. I know you don't sell your Quran, but let's use that. Mommy is selling Quran. So the Quran becomes the goods or the stock, right? So if mommy sells it to a customer and mommy gets cash out of it, then the effect you see is that mommy is losing Quran, which is losing her stock. So the stock will decrease. The stock of Quran will decrease. So that's why we have decrease in asset stock. But you also appreciate that mommy will get money, which is cash. So mommy's cash will also increase. Hence, the asset cash will also increase. And that's the part where you got it. So thank you very much, professors, for that. Please, any question on this one? No question, I guess.
No.
Okay. Let me acknowledge the latecomers. The latecomers in the likes of Francis Oklu. And, I love latecomers because they have a way of. That's a story for another day. Okay, so now that you're able to make the analysis, then what's next for you is to record in the T account. So let's do the recording in the T account. And to be able to do that, we have to refer to the table, which says that when assets or expenses increase, we debit. When they decrease, we credit. And liabilities, capital and income, when they increase, we credit. When they decrease, we debit. So looking at the example that we have just analyzed, we have increase in asset. So what are we supposed to do? We are supposed to debit. And what asset are you going to debit? Cash, right? And you see another decrease in asset. So here we have to credit. What do you have to credit? The obvious answer should have been stock account. But my dear professors, please listen and listen carefully. We don't have stock account. Based on what we are discussing, we will not open the stock account. Rather, we would focus on what happened to the stock. So in this case, we are selling the stock. So the obvious account you have to open will be sales account. Sales account. So anytime you see sold goods, yes, there is a decrease in the asset stock, but the account you open is called the sales account. Please note this and don't make the mistake, because if you answer questions and I see stock account, I'll come to your house and I'll eat all your food. Okay. So anytime you see sold goods, it means we are selling our stock and then the stock is decreasing. However, we open the sales account. Good. So let me open the two accounts as we have analyzed here. Okay, so let me edit the account. So we have realized that we will need the cash account, and we will need the sales account. So instead of opening stock account, we'll open sales account because we sold the stock or we sold goods. Okay. Please, are we all comfortable with the account that we have to open?
Yes, please.
Okay, great. So now what do? We have increase in asset, cash, hence we open the cash account. And since asset is increasing, the principle says when asset increase, we debit. So it means that we are supposed to debit cash and then we'll credit the sales account, because in the stock there is a decrease. And when there's a decrease in asset, you credit. But here we credit the sales account and not the stock account. So let's do the debits and credit. As you know, the debit should be on the left side, right? So we put the date of the transaction, which happens to be 7th January 2022. So in the cash account, 7th January 2022. Then we put the details. Like I told you, the details is the corresponding account, as in the other account. So in the cash account, the details will be sales. Then you put the amount there. The amount was 1,000 Ghana cedis. So we put 1,000 Ghana cedis. And like I said, you always need to put your currency on top of the amount column. So let me put my currency and the amount to cost. Okay. So let me put it in the sales account too. So in the sales account, we realize that we have to credit it because the asset stock was decreasing. So we put the date 7th January 2022. The details will be cash, and then the amount will be 1,000. So professors, anytime you see that the business is making a sale of goods for cash, then this is what is going to happen. It will never change. What if it's for check? If it is for check, then the only thing that will change is that you will not have the cash, but you have bank. Okay, that's the only thing that is going to change. Instead of the cash, it will be bank. But the debits and credits, the increase and decrease remains the same. Okay. Now let's look at where the goods was sold on credits. So let me put another example here. Please, if you have a question, you can ask me so that I will address it. Okay. Today we are not leaving any stone unturned. But I guess because of time, we may have to do the credit sales in our next session. Okay. So let me pause here if there are questions on the sale of goods for cash or check before we meet in the next session. Okay. Professors have no questions. So let's meet in the second session to continue the sale of goods. Thank you very much, Professor. See you.